It's the largest and most liquid market in the world. I'm Brigid Taylor and this is Currency Wars. Notable highlights from the last week. The US existing home sales producing their lowest reading since mid-2012, which signals broad stagnation in the housing market, with demand likely to have been crimped by a period of higher mortgage rates and subdued real wage growth. Meanwhile, the soft HSBC Chinese manufacturing PMI for April marks the fourth month in the contraction territory. This, as improved domestic demand, is offset by weak new export orders and the unemployment. These figures continue to have a knock-on effect to those commodity exporters reliant on demand out of China. In turn, we note a weakening in the Australian dollar and the rand as a result. On a more positive note, the Eurozone manufacturing services PMI both surprised to the top side, bringing the composite reading up to 54 and marking a mid-2011 high. The growth in the Eurozone is by no means shooting the lights out, but it is not indicative of an economy that is starved for monetary stimulus. Meanwhile, back home, the headline CPI in South Africa was slightly higher than consensus, at the top of the SARB's target band at 6%. However, the core CPI accelerated to a January 2010 high of 5.5% year-on-year. This appears that the prolonged period of margin squeeze that has reached a point of saturation is suggesting that there's risk of a more pronounced inflationary pressure that is starting to show, and this could definitely be evident in Q2. Meanwhile, FRA yields adjusted higher and are now pricing in a roughly 50% chance of a 50 basis point hike next month at the MPC. Suppressed yields in the Eurozone and in China are keeping the rand supported for now. However, local bonds are vulnerable to a readjustment of risk perceptions, should we continue to see short-end US rates point higher in the US. The increasing tensions in the Ukraine and a weak growth in China are added reasons to be sceptical on the rand, given the uncertainty surrounding the latest platinum sector wage offers and the approaching elections. Now that we've seen the lay of the land, I'd like to welcome my guest, Colin Wakefield. Welcome once again, Colin.
Hi.
Right, so we're in Easter week, pretty quiet.
Yes.
Rand remaining within that 40-80 sort of band.
Yes.
You know, I think we need to just look at what the lay of the land is right now, just with regards to, there's been quite a lot of data. We've had a lot of PMI, we've had the CPI,
yes.
And then going into the following week, we've also got quite a lot of public holidays and we've got our voting. So there are some things to, you know, keep at the back of the mind.
Yes.
However, it looks to me, and you can correct me if I'm wrong and jump in here, is Rand still predominantly being led by what's happening offshore?
Very much so. I think the local developments actually, if anything, have been slightly rand negative, one would guess. The news out today about Eskom.
Yeah.
Of course, the slowing data, as you've mentioned, the PMI number a little bit disappointing.
Yeah.
And of course, the ongoing protracted strike in the mining sector.
Yeah.
These are things that we're familiar with and not a real surprise, but certainly, unfortunately, not positive. Very much a global picture, driven by, of course, the Fed, as
Yeah.
always, and in particular, the events in the Ukraine. So far, the market has taken the Ukraine situation quite well,
Yeah.
which I think is actually quite interesting because it's certainly very volatile there at the moment. And I think that's sort of what's trapped the rand.
But it's like we're in this place of complacency almost. You know, we know, so we're looking at all of this. We're looking at a landscape where, like you mentioned, we've got the Ukraine. It's sitting. It has nothing erupted, but it's boiling. We've got the unending strikes. We've got our elections that are coming up. A lot of commentary talking about the fact that all of this has already been priced into the rand, but that's never really so until something proves that it hasn't really been.
No, absolutely.
So for now, we're continuing to remain within that band. And as we were saying offset earlier, the interesting thing in South Africa is we've seen a large inflow into the bond market, helped to support the rand. However, we didn't see our auction take-up as predominant as we've seen previously, and in fact quite concerning.
Yes.
Do you think that that's just as a result of holidays, or do you think that that is a sign of potential, you know, looking at US treasuries that may uptick?
I think it's actually both, to be honest. I think the market was waiting for the CPI print that we had out yesterday, and a little bit of nervousness given that it was a high survey month, so a lot of seasonal factors affecting that number. The number, of course, slightly exceeded market expectations, most importantly at that critical 6% upper end of target band.
Yes.
I think that was one factor.
And the FRAs are pricing in now, they've gone up to 50% of a 50 basis point hike in the next meeting, right? So the market is now looking at that top of the target band. is a concern because the SARB does remain, in terms of their monetary policy,
yes.
Concerned about inflation. But we have still got this growth engine that is remaining slow.
Yes.
So let's look a little bit offshore. If we're looking at Rand being driven by offshore factors, we saw the US housing starts come out, disappointing
Very
number.
disappointing number.
Specifically on the back of, there was that slowdown expected because of the weather conditions. However, it really also talks to what we're seeing in South Africa with regards to the consumer being under pressure and interest rates remaining for a mortgage-backed investment in US terms relatively high.
Very much
But
so.
then if we look at the Eurozone, I mean, their PMI was actually quite surprising. So that zone seems to have remained pretty stable, and it hasn't, I mean, it's not shooting the lights out, but at least it's keeping itself above water.
Yes.
However, in South Africa, as much as we say that, the global picture hasn't really changed, we're still looking for that growth engine. And as we mentioned earlier as well, the Chinese PMI also coming out pretty negative. So from that perspective, I mean, where do you see growth coming from? Do you continue to see inflows into South Africa? And let's talk about like things that open opportunity that we can watch out for and things that are potentially risks.
Sure. I think you've hit on a lot of the key trends. It's very much a case of as is until otherwise. One good US data print, one disappointing print. So I think we're on course for an additional taper in the asset purchases and money printing later on at the end of the month. We'll hear from the Federal Reserve.
Despite the housing starts?
Despite the housing starts, I think there's a seasonal element, and of course the US housing market has and did bottom almost 2 years ago, so we've seen a real rebound from at least the base levels that were really disappointing. Some really good jobless numbers, so those jobless claims, a measure of short-term unemployment in the United States, at their lowest level since 2007. So very much to and fro. Eurozone, same picture, really good PMI numbers. IFO numbers this morning, German business confidence, relatively attractive, but inflation is nowhere to be seen. So concerns about deflation. In this context, investors are not willing to commit huge amounts of money to particular asset classes. And so I think in that environment, South Africa will continue to float along, as with many other emerging markets, now that the taper panic is over.
But as a riskier asset, so if we look at South Africa from a global investor perspective, and we say we've got things to consider like the US Treasuries. If we continue to see this tapering, and if we see an increase in the tapering, the US Treasuries will slowly increase. So in other words, the yields will go higher. That means potentially that we won't see as significant flows into South Africa, which potentially could pose a risk.
Very much.
But on the flip side of that, we are starting to see growth out of the big developed markets, like you mentioned earlier, not robustly and certainly not shooting the lights out, but forming a nice base where growth can increase from. In terms of the Chinese situation, now that for me is a massive concern because that really implies a lot of export demand out of China waning. So you've seen the Aussie dollar, you saw the Rand come under pressure due to those kind of facts. Do you think that is a predominant risk that we need to keep an eye on? I
do think so. We actually discussed it the last time we were on the show together. The market is also pretty calm about that murking risk to an extent. The market seems to assume that the Chinese authorities, whether it be the central government or the central bank, will reflate, will pump money into the banking system as and when needed in the event that credit growth starts to drop off. And in particular, the central authorities will continue with their investments in the infrastructure and rail sector. So Chinese growth, frankly, has been really disappointing. This is, of course, very bad news for the real economy in South Africa, given that China is such a huge destination for particularly our base minerals and export sector. So certainly something to keep an eye on. And the big risk is that the Chinese authorities don't react as expected, because the market is anticipating some measure of support later on in the year, given the disappointment.
So that's something that I think we need to keep our eye on and certainly just watch out for. Let's go back to the Ukraine issue as another boiling pot that's simmering at the moment. Do you think that that's going to have an effect directly on South Africa, or do you think it'll be indirect by virtue of the fact that it predominantly will affect the Eurozone?
I think it'll be an indirect effect. One of the interesting things is, and we spoke about the bond purchases earlier, a lot of money has actually left Russia. Of course, the US has imposed a limited measure of financial sanctions, potentially more to come. And so people who invest in emerging markets for a living are saying, where can we deploy that cash? And I think South Africa actually, funnily enough, has been one of the beneficiaries of that flow of funds out of Russia. We need to get a sense of how risky it is that conflict broadens into the wider region, and whether that, of course, is going to start affecting not only financial markets, but in fact the regional economy.
So if we're looking at investment from a global perspective, which is ultimately what's going to drive the Rand in the short term, failing which we see something happen in South Africa, an unsuccessful election, or we see some more mining strike action, etc. The global picture that we're looking at right now, in terms of those inflows in South Africa, the next MPC, what are you looking for in terms of interest interest rate decisions, because we still remain on the back foot in terms of hiking and our hiking cycle and offering attractiveness for those investors from offshore into the South African market.
Very much, and of course the Reserve Bank's credibility is very much on the line, given that we are almost certainly going to breach above that 6% threshold. RMB is expecting a 50 basis point rate hike in May, but it's very touch and go at this stage because the MPC is very cognizant of how weak the underlying South African economy is. We know that a lot of the inflation is as a result of the weak rand.
Yes, and the core inflation. I mean, core inflation surprised to the upside as well, and that just shows that those, you know, the retailers are getting squeezed in terms of their pass-through. So that's something that's going to come through down the line. So it seems inevitable as though there is going to be interest rate hikes down the line. But then it draws to question, do you want to invest in South Africa at these levels? So those are, I think, maybe, Colin, you know, we'll round up now in terms of our view and our terms for the view going forward.
Yes.
But I think that those pretty much cover the points for the week. So just to recap, keep an eye on what's happening in China in terms of their policies. Keep an eye on what's happening with regards to the US treasuries, and then obviously talk around South Africa and whether or not we potentially will hike interest rates, and then looking for you know, what's going on in Ukraine and if there's any knock-on effects in the South African market, because we are predominantly continuing to be run by what's happening offshore. So now that we know where we stand, the real risks and opportunities, it's time to pull out the big guns. Let's have a look at real levels. Let's talk about technical levels on the rand. What are you looking for?
Over the next 2 weeks, I think we're going to remain very range-bound, to be honest. I think we're not going to get above 1068. Of course, the elections locally mean it's a fantastic holiday season and activity economically is relatively muted. On the downside, 1038 is a key technical level from a longer-term perspective. I think if we go through that, we're going to see significant rand strength into the end of the year, which would surprise many people. So those are the longer-term levels to watch out for. In the short term, barring any unanticipated developments, I think we're very much stuck between the 42 level and then the 68 level on the upside.
Okay, thank you very much. So just in conclusion, just for your trading strategy for the week, technicals sort of looking a little bit contrary to what we're seeing on the fundamentals. However, Colin's looking for 1068 on the top side, sort of 1070, and downside, if we break through 1038, we potentially could see a lot more strength. Thank you very much for your views once again. And if you'd like to send us any questions or comments, you're welcome to do so at CNBC Africa Currency Wars 410, as well as myself at Brigid Taylor. Until next week, good luck in the trenches.